Chapter 2, Learning Objective 2, Analyze Transactions Using Double Entry Accounting. Under the double entry accounting system, each transaction is recorded in at least two accounts where the total debits always equal the total credits. The sum of all the debit balance accounts in the ledger must equal all the credit balance accounts. So remember the rule that debits equals credits is rooted in the accounting equation. So assets are on the left side of the accounting equation and therefore increase with debits and decrease with credits. Liabilities and equity are on the right side of the accounting equation, so they must always increase on the right or the credit side and decrease on the left or debit side. In Chapter 1, transactions for Big Dog Car Works were analyzed to determine the changes in each item of the accounting equation. So we'll use those same transactions to demonstrate double entry accounting, including T accounts. For our first transaction on January 1st, Big Dog issued shares to the owner for $10,000 cash. We identified the accounts affected here to be cash and share capital, both of which are increasing. Since cash is an asset and assets are normally debits, cash goes up with a debit of $10,000 and is entered on the left side of the T account for cash. Share capital is an equity account and is normally a credit, so share capital must increase with a $10,000 credit, which is entered on the right side of its T account. On January 2nd, Big Dog borrows $3,000 from the bank. Now, because the bank will deposit the loan proceeds into the company's account, causing cash to go up, there must be a debit to the cash account on the left side of the T. The bank loan is a liability, which will also go up, and the normal balance of liabilities are credit, thus we're going to credit the right side of the T account for the bank loan. On January 3rd, the company purchased equipment for $3,000. The company is acquiring equipment which is an asset, therefore the equipment account must increase with a debit on the left side of the T. At the same time, cash is decreasing as the company uses it to pay for the equipment. Since cash is also an asset but it's decreasing, it must receive a credit on the left side of the T account. On January 3rd, the company purchased a tow truck for $8,000, paying $3,000 in cash and borrows the rest on a loan. The truck, which is an asset, is increasing by $8,000 with a debit on the left side of its T account. Cash, which is also an asset, is decreasing by $3,000 with a credit, and the bank loan, which is a liability, is increasing by $5,000, and that must be a credit. Notice here that our total debits are $8,000 and the total credits are $8,000, so our transaction's balanced. On January 5th, Big Dog paid $2,400 for a one-year insurance policy. The prepaid insurance is an asset because it represents a prepayment of the policy for the next year, and thus is an asset that is increasing by $2,400 with a debit to the left side of the account, and because the company paid for the policy, that means cash, which is an asset, is decreasing with a $2,400 credit. On January 10th, the company paid $2,000 cash to reduce the bank loan. The bank loan's a liability with a balance that's normally a credit, but it's decreasing. Therefore, a debit to the bank loan is necessary here. Cash is also decreasing by $2,000, and this is accomplished with a credit. On January 15th, the company received $400 from a customer in advance of services to be performed. Receiving cash means cash is increasing, so that's a debit to cash of $400. The other part of the entry requires a credit for debits and credits to balance, and the advance from customers is unearned revenue, which is a liability and is increasing with a credit of $400. On January 31st, automobile repairs of $10,000 were made for a customer, $8,000 was paid in cash, and $2,000 is to be received from the customer in the future, and that's what we call accounts receivable. The company is receiving $8,000 in cash, resulting in a debit. Accounts receivable is also an asset, which represents the amount the customer will pay later, and this is increasing by $2,000 with a debit. The balancing amount is to repair revenue, which ends up in equity via retained earnings. Remember, the normal balance for revenue accounts is a credit, so a credit of $10,000 is necessary here. Again, notice that debits and credits both add up to $10,000, ensuring a transaction's in balance. Also on January 31st, the company paid a bunch of operating expenses, $1,600 for rent, $3,500 for salaries, $2,000 for supplies, all of which were for cash, and $700 for truck operating expenses, which was on credit. All of those expense items ultimately affect the profits and therefore the equity balances of the business. Since expenses cause profits to drop and profits end up in equity, the equity would decrease, so those would all be debits to their respective accounts. The cash expenses add up to $7,100, so cash is decreasing with a credit of $7,100, and the truck expense wasn't paid yet, so it's a liability of $700 in accounts payable, which is increasing. Again, total debits of $7,800, balance against total credits of $7,800. The last transaction on January 31st is for cash dividends paid to the owner. Dividends are an equity account. However, its normal balance is always a debit. This is an exception we'll talk about later, and is therefore increasing by $200 with a debit on the left side of the T account. The dividends are paid in cash, which is decreasing with a credit. You can also think of this in a different way, where dividends cause equity to decrease, and decreases in equity are always recorded with a debit. After the January transactions of Big Dog Car Works have been recorded in the T accounts, each account is totaled, and the difference between the debit balance and the credit balance is calculated as shown here. Here we have all the T accounts showing all of the transactions as well as their ending balances. We can see that cash has a debit balance of $3,700, the bank loan has a credit balance of $6,000, etc. The numbers in the parentheses refer to the transaction numbers used in the preceding section. We've clustered all the asset accounts in one column here, and we can see they all add up to $19,100. All the liability accounts add up to $7,100, and all of the equity accounts add up to $12,000. And when we add the equity and liabilities, they equal the total assets.